Guys, what's up? Thank you for checking into the channel. This video, I honestly just wanted to talk to you guys because there's been so much going on in the market, and a couple of things that I think are kind of crazy right now is the fact that subprime mortgages are actually pricing out very close to, if not the same, to what hard money is pricing. So right now I'm seeing quotes coming in the 8 to 9% range. And funny thing is that a lot of the private money investors are still quoting 9, 10, and 11%. So for people that are actually trying to buy properties or actually anything in the marketplace, and they're thinking about going subprime, let's back up. I'll explain what subprime is. Subprime is old school for alternative documentation. So basically, all the self-employed borrowers who can't qualify using tax returns, we used to do programs called alternative documentation, stated income, subprime, where you use their bank statements, their profit and loss to document their income, because clearly these people are usually making more money than most of us, except they don't really declare it. And how is it even possible that you can make a lot of money and not declare it? Picture this. Imagine you're running a construction company and you bring in a couple $1 million a year. Well, that's your gross sales. But then you got a laundry list of expenses underneath that, which is basically materials that you've used, right? God knows, obviously they're documented, but subcontractors, gas, travel, insurance, all this stuff. So basically what these guys do is they write it down to almost nothing, and a lot of these guys end up really not having to pay a lot of taxes. Again, I'm talking about the hypothetical, and that's not everyone, but it's a framework of how these guys are able to bring in a lot, have a lot of expenses, and then at the end of the day they're not showing any income, which serves them well in the sense that they don't have to pay any taxes. But then when it comes down to qualifying, they always had that vehicle available to them where they could use all those massive deposits and show them to the lender, and the lender would be like, well, yeah, you know what, you're in construction, we know that at least 50% of your income is expenses, so we'll give you credit for that other 50%, right? And that was still a lot of money, but that was okay when rates were, say, in the mid 4s, in the mid 5s, even in the mid 6s. But now these rates have popped up to basically where private money is. And you know why? Because when we originate all these conventional mortgages, you walk in with your tax returns, like you walk into the bank, the buyers of those mortgages are Fannie and Freddie Mac on the secondary market. They're insured by the government. But when these folks are using funds, hedge funds from Wall Street that basically just want to invest in mortgage-backed securities, which is basically just mortgages, they are suddenly unsure of whether they even want to invest. And those people that are still investing, meaning those funds, are saying, we have no clue where the market is, and the last thing we want to do is give you our money for less than what it's going to be worth in the next 3 to 6 months. So guess what? We're going to actually price it out for the same price that hard money is going for nowadays. And if you like that, take it. And if you don't, you know what? We don't even know if we want to lend to you. And that's why over the past, say, 3 months, there's been a number of very large lenders, non-QM lenders, subprime lenders, that have actually gone out of business. They've been around forever, and I was actually in shock to hear that. But you know what? When COVID came, a lot of these guys pulled out of the market, meaning, they just stopped lending altogether. I was in shock. I actually had a handful of deals. Some of them were purchases, and they basically called me up one day and they said, we're just not lending anymore. And I was like, how is that even possible? And they're like, yep, not doing it. And then that was followed by, we will lend, but there's gonna be some overlays, different things that they want that they didn't want before, just to be cautious. As the market got worse, they've decided, if you're in the pipeline right now, and typically you can pay for a rate lock extension, we're not offering those anymore. I actually had loans where, standard practice, extend the lock, we're coming due. Nope, we're not extending any more locks. Sorry. That was crazy. Now we're at a point where the cost of money for that, meaning, you know, the subprime is basically the same as hard money. So it's crazy. We don't really know where the market is headed. The reason I'm actually doing this video is because I would love to look back 6 months from now and say, you know what, I did this video and I had no idea where we're gonna be 6 months, a year from now. My personal feeling tells me that rates are gonna roll back because I feel like the Fed did, in my opinion, a very poor job of, you know, the way they're handling rate increase. They could have literally done it gradually, but COVID came and they were gonna do it before, but they never did. And so inflation, hyperinflation went through the roof, and they decided, you know what, the whole thing got super messed up. So the cost of money was so cheap, everyone's buying everything. And so there is a massive amount of demand and there's, you know, supply so limited, so everything's gone through the roof. We have to stop it immediately. And that's exactly what happened. They went through and they started hiking rates like crazy. But when you do that so fast, you know, there's a collateral damage because as a matter, you know, I'll give you an example, right? We're a lending shop, and I can tell you for all lending shops across America, basically they went from funding, you know, if 100% is capacity, they're down, their business is down at least 80%. That's massive. How can you take a whole industry, bring it down 80%? Well, you can if you take such extreme measures. I personally think it's too extreme, and I personally think it's gonna roll back because it's not sustainable in the sense that no one can buy anything right now. The thing is this, back in 1999, I could share a rate sheet with you guys, and you know what, maybe I'll pop it on the screen so you see it. Rates were actually similar to where they are today, but there's a difference, and the big difference is the fact that back in 1999, the same home today that is 1.3 million was actually worth around 350,000, maybe. All right. So mind you, you have the same real estate worth a fraction of what it's worth today, maybe a fourth of what it's worth today, and you have the same level of rates. That makes sense because then it's still affordable. But what happens is when you take rates and you hike them so much to the point where if you're trying to qualify somebody, again, I'm in LA in California, it becomes virtually impossible for this person to be able to qualify unless you roll back prices about 30%. Crazy, right? So that means that for us to be able to get back on the bandwagon, for people to be, you know, able to afford what they were able to afford 5 minutes ago, that means that prices need to roll back about 30%. So if you have $1 million house, which is very typical out here, actually it's below typical, that means that that house has to go to around 700,000 for us to be able to get back into the conversation of getting you qualified. Just because interest rates went up doesn't mean that people's salaries went up. That's the challenge. And because of that, you're seeing a ton of people move out of the area for the simple reason that one, they just can't afford to buy anything. It's way too expensive. And you could probably get a comparable house that's maybe even newer and nicer in a developing state. I'm gonna even throw that out there for a fraction of the price, and you no longer have to simply live for your mortgage payment, all right? So that's basically how I feel about what's going on today. It just kind of all came out, and you know what? I would love to know what you have to say about it, honestly, because we're in very transitional times, and I think that it's not gonna be like this forever, or not even for, you know, maybe for a year or so. And I think we're gonna have to see some major changes because I think people are gonna have a very hard time affording homes, especially in LA or maybe the metro areas, because LA is not the only expensive spot. But again, put it in the comments. I would love to know what you have to say about it. If you like this video, give it a thumbs up, support. This is basically how Google knows that this kind of content is relevant to you and that you enjoy it. And as always, I really appreciate you guys watching. If you haven't subscribed to my channel, please do so. I thank you, and I will catch you guys on the next video. Take care.